Hi everybody, Luis with the DiGanzini Real Estate Group here in Orange County. We are back. So today, one of the things we're going to talk about is somebody sent us an email and asked us if we can talk about what are the things or the factors that actually make a market decline or make a market adjust. Everything's different. I'm going to speak about what we see, and every time we call it an adjusting market. More than likely it means a declining market for some people. If you're in financial planning or finance or in stocks or different trades, you might call it a declining market. So I'll go over a very simple way of explaining what goes into a declining market, or what happens, what causes a declining market, declining real estate market in this case, because that's what we do. So very simple. I'm not going to complicate it with a lot of stuff. One of the things that happens is we're going to go through this. Plus B equals Z. So I would see it as a formula. There's a lot of factors that go into it, but this is probably the simplest one. And we don't have a lot of time, so I'm going to make sure that I take a little bit of time explaining each one of these, which is pretty simple. We don't want to complicate things. So X, I would say this is the interest rates. The interest rates do affect the market, whether it's up or down. It's definitely going to affect it. In this case, the interest rates are pretty stable. If you're buying a new property, you put 20% down, you have a good credit, you have some reserves, you make good income, you can still get 4% when buying a property, which is pretty nice. And even when you're buying investment property, you can still get under 4.25%, under 4.25% with 20% down. And as long as the property is within the conforming rate, which we call it, and it's under 600,000. But anyways, that is what's gonna cause this, or will be part of this overall formula that will cause the market to decline or to adjust, as we call it. The second thing is inventory. Inventory. So inventory in Orange County, typically a standard inventory or standard market is about 10,000 properties for sale at all times. Right now, we still have very low inventory in most of Orange County. There are some areas that have a lot more inventory than others. For example, Newport Beach, Huntington Beach, Laguna Beach, and Laguna Niguel have a lot of inventory. So what happens then is prices start to adjust, or the market is stabilizing. Every market is different, every neighborhood is different, there's no things that are alike. In this case, what we are seeing is that Newport Beach, Huntington Beach, Laguna Beach, and Laguna Niguel are adjusting because of the inventory. So in that case, it's shifting towards a buyer's market, we call it. The other thing, B, this is consumer confidence. This is the amount of cash that's in the market. It's also the amount of confidence people have in the market. If they feel that the market is strong and they're gonna get future growth in that particular property they're buying, it's gonna help with the overall market decline or increase. Right now, what we're still seeing high consumer confidence in this case. When there's low consumer confidence, then you're gonna have some trouble, and that's when all of these contribute to either a declining market or an increasing market. It's not just one factor, it's actually all of them combined. There is more to it, but this is the basic formula, I would say, to describe an increasing market or a declining market. So hopefully that helps. If you need a better explanation for this or a more detailed explanation, we can definitely do it. It takes a little bit more time, but we are more than happy to do it. So if you have questions, drop us a line, send us an email, hashtag us, whatever's easier for you, let us know, and we will see you soon.